Good morning and welcome to today's 5 with Fitz. I'm Keith Fitz-Gerald. Thank you as always for spending a few minutes with me. I trust this video finds you well, wherever it is it finds you. Anyway, I'm going to keep it brief today while we recover from Shindig 26, our annual One Bar Ahead client meeting this past weekend. Nearly 200 folks flew in from around the world for yet another amazing get-together filled with laughter, with learning, and all sorts of new, exciting investing research. So thank you for making the trip if you're one of them watching along today, and here's to seeing you soon if you'd like to attend in the future. Anyway, and if you'd like to learn what they learned, I'd love to toss my hat in the ring. People tell me regularly that One Bar Ahead has changed their lives. Now, back to business, or at least the financial markets anyway. Big tech earnings are the story this week. Tesla, Alphabet, Intel, IBM, all reporting, right? Wall Street's raised expectations for all of them, and prove it is very definitely the mood. So far, so good. Here's my playbook. All right, number one, prove it or lose it. Roughly 10% of the S&P 500 companies have reported Q2 26 results so far, which means that we're still very early days. Of that 10%, roughly 88% have delivered positive EPS surprises, while 85% have beat on revenue. Better still, though, the blended year-over-year earnings growth rate for the index is tracking at 24.7%. And if that holds, it'll be the second straight quarter of earnings growth above 20% and the seventh straight quarter of double-digit earnings growth, according to FactSet. Now, read, listen, digest that again. 7 consecutive quarters of double-digit growth. Now, why does that matter? Well, try this on for size. Earnings and price have a 98% correlation over time, which means that if earnings are still rising, take a guess at what will follow eventually. Exactly. Prices. Now, you know what to do. All right, Keith's investing tip in this department is very simple. Prices and value occasionally divorce, and many anxious investors blow a gasket when that happens because they let their emotions get the better of them, right? Smart investors, on the other hand, tend to wade in when they see great companies being put on sale, regardless of why. Number two, time to buy the chip dip. Well, I sat down with the venerable Stuart Varney early this morning ahead of the opening bell, and he asked me point blank whether it's time to buy after the chip index is down 20% from its high in June and technically in a bear market. We also spent a moment on what I expect from Google, Tesla, and Intel, all of which are reporting this week. You can watch that elsewhere on my channel, and please do. Number three, leverage is great until it isn't. South Korean investors piled a net $9.4 billion into leveraged ETFs tied to Samsung and Hynix, in particular, chasing the AI chip boom. Then the trade reversed. Oh boy, you knew this was coming. One of those leverage funds, which is designed to double whatever SK Hynix does in a day, is down about 70% from its June high, down roughly 50% since its launch. The forums are, of course, full of investors begging for their money back. Well, I get it, but here's the thing nobody tells you, except possibly me, when leverage is working. It's the same math all the way down. Leverage doesn't give a rip if you're right about the story. AI chips are definitely a very real trend and theme with unprecedented long-term demand, none of which matters if you bought it 2x levered and the markets decide to take a breather first, all right? Now, regulators are already stepping in. Korean authorities just raised the minimum cash requirement to trade these dang things tenfold. It's a shame that it took a 70% drawdown to get there. Anyway, my POV, there's a reason I repeatedly tell you to avoid highly leveraged ETFs like the plague, except in a handful of very specific cases. And even then, only with exceptionally disciplined risk management. There's no such thing as a free lunch, not in markets, not in life. Leverage ETFs can make sense for a very sophisticated short-term trader who understands exactly what they're signing up for. The problem is too many investors go in without the understanding of risk, so they chase a hot trend and they wind up getting burned exactly like this. Don't be stupid or you will get what's coming. Number four, oil, hero or zero. Well, what do you know? The market had gotten comfortable with the Iran conflict as background noise, only to be reminded over the weekend that it isn't, right? Now, I get asked often what the play is here and in times like this. And the answer is very simple. Buy the best, ignore the rest, end of discussion. Chevron is one of those names, in my humble opinion. Global footprint, great dividend, growing at 5.8% over the past decade. You've got a super efficient balance sheet. It can potentially be profitable as low as $30 a barrel. So, stands to reason, it's a company you want. But then there's number 5. Google pop is just a little too convenient for my taste today. Shares have popped this morning on news that the company is developing a more efficient AI chip, right? I think the company faces some unique risks at the moment, not the least of which is a one-time valuation associated with its stake in Anthropic. Now, if I'm right, and I think I might be. Bank of America, by the way, has picked up on the same thing. But knowing how big money traders play the game, I've got to wonder if they're engineering a rug pull ahead of earnings. Trade idea, if I'm right, again, I might not be. The play will be to create FOMO ahead of earnings, drive the price up, then create a short, sharp drop after great numbers to wash out the momentum players, trigger trailing stops, and resting orders all at the same time. Bottom line today, don't fall for that kind of nonsense. Aspiring investors obsess about being right, but smart investors focus on being profitable even when they're wrong. Let that sink in. Think about it for a moment. I'm thrilled to be back. And as always, let's make it a great day, a strong week. Look forward to seeing you tomorrow. Cheers. You got this. I promise. Thanks for watching.